And what I didn't realize, but see now, is that she made the one sin that every private equity investor knows they can never make. And it happened because she is as kind-hearted and good as she is smart. And that is...
Cares too much. About this one in particular.
It's a suicide play at this point. She's lashed herself to the side of this thing and refuses to jump off.
The cardinal sin of investing: caring too much, getting too attached, just too emotional. So let's talk about this, and I want to hear what you think below in the comments, because I look at this problem kind of differently depending on whether we're looking at public markets or private markets. So I want to see what you guys think too, whether you agree with me or not. But before we jump into it, I got something that will help you with your public market investing, which is what we're all about on this channel, right? I got this free explosive stocks cheat sheet. So in this PDF, you'll see some of the fundamental and technical factors we use in macro ops to find stocks. It's a quick checklist, but it should really help you out because this criteria helps you find cheap optionality stocks. So these are the stocks where you can bet just a little bit with huge unlimited upside. It's that asymmetry we always talk about. But it's a free checklist. All you got to do is enter your email so I know where to send it. So I'll put a link to where you can do that up above in this video and down below in the descriptions and comments. Okay, so the cardinal sin of investing: caring too much. Now, I agree, this is the worst thing you can do in public markets. When it comes to public markets, and by that I mean like stocks, you should really have zero attachment to any company or any investment. You got to be cold-blooded, just like Rick James. Just cut everything off when you need to. You need to have a level of detachment from whatever you're investing in, because really your investment is just a tool to make you money. You can't think of it as a company that you should start rooting for and treat it like a person that you somehow owe something to. These stocks and these tools, these public market investments, are just there to work for you. You owe them nothing and they owe you everything. No, I'm kidding. The market doesn't really owe you anything either, but you get the point. When you start getting emotional towards one of these investments, that's when you start running into all sorts of problems. That's when you start holding something too long when you should have cut it. Maybe you're emotional because you really believe in the company's mission to change the world, or you're just feeling emotional because you can't handle proper risk management. That loss aversion is too strong. Another thing I see a lot of people do is add to their position as it's falling, saying they're averaging down, which I don't really agree with at all. And really what it turns out to be is just mental gymnastics to help you rationalize what you just want to do emotionally. Most of the time though, it's not a better deal. You're just being emotional and stupid. So a great example of where this happens all the time is Tesla. You've got crazy bulls and crazy bears. And for some reason, they think that they should live or die by that investment thesis. But honestly, it's just a stock. Who cares? My opinion on it is that I would not even touch it with my own money because it is too wrapped up in sentiment. Anything could happen, especially with Elon at the wheel. And I'm a huge supporter of Elon. Like, I really like him. I really like what he's doing. But that doesn't mean I want to invest in his public company. To me, those are two different things. And public markets are a secondary market. So even if you're buying shares of Tesla, you're not directly helping Elon somehow. You're buying those shares from another investor. The IPO, where Tesla would have collected all its money and then new share issuances, those have already happened. You're just trading it back and forth with someone else. Now, it is true that if you buy a stock and the price goes higher and the price stays higher and other people are buying it, then that particular company might be able to raise money more easily. They can issue debt more easily, they could issue more shares and people will buy them, and all that equates to more money to manage their business. And then also, if a stock price is high, it's easier to hire because they can hire by offering options to these new employees. And no one wants options in a company where the stock price is shitty, right? So yeah, if you buy their public shares, you can help that happen indirectly, but I don't know, that's not much of an incentive for me. For the most part, you're not really directly involved. That's why there's that saying, trade them, don't date them. There is no reason you should become emotionally involved with any company. And I've explained to you guys a bunch of times how I trade with my momentum system. You can learn more about that at this link right here where I explain it, but it comes down to me just looking at a number. Does this stock have the highest momentum or does it not? If it does, I'm going to invest. If it doesn't, then I'm not. I honestly don't even care what the name of the company is, what they do. I don't care about any of that. It's just purely quantitative because I'm just here to make money in the market and that's it. So public markets, no emotions. That makes sense to me. But private markets are a little bit different when I think about it. Now, of course, I understand that even when you're in private markets, you are still 100% profit oriented, or at least most, investors are. But in private markets, in some areas of private markets at least, there is a difference between how much information you actually have versus public markets. So the great advantage of public markets is that you have a ton of information and the market is really liquid. So you get access to probably the best fundamental, which is price. You don't have all that liquidity and info in the private markets. Now, really in the private markets, it kind of depends on what stage you're at. that. So later stage investors and later stage companies, they're going to have more information. But if you think about an angel investor in the initial round, they don't have much information at all. They're pretty much going off intangibles, like, is this founder good? Do I think this team is good? So in my mind, private investing is not as quantitative as public investing. But even as I say that, I'm sure there are a number of VCs who have pretty much fully quantified these intangible things. Just like Dalio and Macro, he's quantified everything, right? And Macro, when you first think about it, you're like, no, there's no way to quantify that. It's discretionary. There's too many factors. But he did it. And really, you could quantify anything if you have enough data, right? Which I'm sure there's some of these VCs who have done it too. So if in the private markets you are dealing with more qualitative data, which is kind of more intangible, then I see emotions getting more involved with that. If you got to judge the character of a founder, that's more of an emotional decision, isn't it? But where I see emotions and getting attached become really important is when you start a company, or if you're a VC investor investing in the seed stage, in the very, very beginning. And Rebecca's case with Saylors kind of relates to this because she took over the company and became the CEO. So she's running the company, not just investing in it. Now, in these cases, I think the attached emotional ones that care way too much, those are the only guys that actually make real change. Lately, I've been reviewing a lot of stuff from Naval Ravikant, the famous VC guy who's like a guru. Everyone loves him now. And I know why. I mean, he's a really smart guy, says some real smart stuff. But he just did that interview with Joe Rogan. He has interviews with Tim Ferriss, a bunch of different interviews. You can check it out. But one of the things he said was that the best founders are kind of borderline crazy. They get super emotional and super attached to the point where they don't listen to anyone and they don't even listen to data. They just do what they want to do. And somehow they end up moving heaven and earth to make something that looked impossible possible. So Naval explained there's like this thin line between someone who's a genius and someone who's just crazy, because they have a lot of those same characteristics. And this isn't the first time I've heard something like that. Like, one of the most impactful things I've ever watched from Steve Jobs was this interview or whatever in 1994 where he talks about his perspective on life. And you can look this up on YouTube, Steve Jobs' vision of the world. But I loved what he said in this, especially this part. He said the minute that you understand that you can poke life and actually something will pop out on the other side, that you can change it, you can mold it. That's maybe the most important thing. It's to shake off this erroneous notion that life is there and you're just gonna live in it, versus embrace it, change it, improve it, make your mark upon it. Basically what he's saying is that you can take things around you and mold them into what you want it to be. And you know, you've heard stories of Steve Jobs. He was kind of one of the crazy ones, but a genius too. Doesn't take no for an answer and somehow makes the impossible possible. There's this great quote from George Bernard Shaw too. He says, "The reasonable man adapts himself to the world. The unreasonable one persists in trying to adapt the world to himself. Therefore, all progress depends on the unreasonable man." So once again, you gotta be a little crazy and attached to make some really big changes. Which in Rebecca's case, if you were gonna turn around Saylors or Sears, I think you are gonna need that emotional attachment. Versus Axe, who represented the Eddie Lampert, you know, the hedge fund guy coming in, he's gonna treat it as purely investment, be completely detached. So as we've explained in those previous two videos about Sears and the finale and everything, which if you haven't watched, I'll link to right here, he'll cut up the company and sell it for parts so he can make that profit. So think about the difference there. Axe is the public market guy, Rebecca is the private market person. Rebecca would try and turn the company around and Axe would just cut it up. If you're trying to make good change, I would kind of go on the Rebecca route. And you gotta be emotional attached to be able to do that because it's nearly impossible. And it really doesn't rationally make sense. And then your real life example is once again Elon Musk. The business of space travel and electric cars, they are not good businesses. They're always on the cusp of blowing up and they looked impossible. But Elon is one of those special people, doesn't take no for an answer and he gets it done. But even right now, you know, after all these years, Tesla still does not look good, but it's just inspiring to see Elon put it all on the line at all times and just make things happen. So that's why if I was involved in private markets, which I'm not, so this is all speculation, take it with a grain of salt, might even sound a little naive, but what I would be doing is going for those moonshots as well. There'd obviously be a huge failure rate, but if I was playing in the private markets, that's what would be interesting to me. If I was going for pure profits, then I would play in the public markets, which I already do, and that's how I treat it. I could care less about any individual stock. I'm only looking at my P&L, and it's very Taylor style, just robotic, all based off numbers. I don't even care what the ticker is. And to me, the public markets, you have all this data, especially the most important data, price, that makes it all just much easier than dealing with intangibles in the private market. But that's not to say that I would go and try and lose all my money in the private markets, right? If you bet on something like a Tesla in the early stages and it actually works out, you're gonna make a huge killing, right? Because there's that idea that doing something harder that no one else is trying to do, you should actually focus only on that, because that's what's gonna give you those outsized returns that will cover everything. You need to do that once and you're set for life. So there is obviously still a strategy about investing investing in moonshots, which is what a lot of these tech companies do too, like Google X, right? But I think you gotta have a lot of money and you gotta be a little crazy to do that, which is why I prefer the easier public markets until I have enough resources to just shoot shots in the private markets. But let me know what you guys think about all of this. Where do you think emotions come into the investing game? Where do they help and where do they hurt? If you think they come into the game at all, comment down below. You know I read all the comments. And don't forget to go grab your free explosive stocks cheat sheet. This checklist is really gonna help you out if you're looking for public investments, which I know most of us are if we're watching Fallible. And you'll see how great data is in the public markets because this checklist really takes advantage of that data. And a lot of this you would not have in the private markets. So check that out, link up above and down below. And if you haven't already, make sure you subscribe to this channel and smash that bell so you get email notifications whenever we release new videos. We're doing videos almost every day about all types of topics, so subscribe and I will see you in the next video. Stay fallible out there. Bye.